Here's something that might surprise you. The money that you've got sitting inside your savings account might not actually be getting you the return you think it is. It's not because it's a bad rate. It's because there could be a better option sitting right inside of your home loan that you're either just not aware of or you're not using properly. Today, I want to talk all about how an offset account works and how you can best make it work in your favor. I'm also going to share the 2 mistakes I constantly see, as well as the 3 paths that your money can take, because one of them quietly builds wealth in the background without you having to change much about your lifestyle. Okay, so how does an offset account actually work? An offset account, it sits alongside of your home loan, and the balance that's in your offset accounts is subtracted from your loan balance before the interest is calculated. And that's done every day. If your loan is sitting at $700,000 and you have $50,000 sitting in your offset account, what that means is the interest portion of your repayment is only charged on $650,000, not the $700,000. The best thing about this offset account is that $50,000 you've got sitting there, it's your money, it's in your name. It's not like you've given it to the bank as a repayment. This money stays liquid. So that means it's accessible to you at any time. It can be pretty simple, but here's how it can go wrong. Mistake 1 is that you might not actually have an offset account. A redraw facility inside of your loan, it tends to look identical to an offset account. Same screen, same balance, same ability to move money in and out, but they're really not the same thing. The offset account is your own deposit account where you've put your money into and it's in your name, accessible at any time. When you put money into a redraw facility, that money now belongs to the bank. So you've made an extra repayment, and yes, you can get it back, but technically that's on the bank's balance sheet. Now, this difference can matter significantly, particularly if you own an investment property. When you make an extra repayment into your redraw facility, that money becomes part of the loan. If you want to get that money back out of your redraw and you want to use it for personal purpose, the ATO will always look at that money and what it was borrowed for. If the answer was something personal use, your interest portion of that loan for an investment purpose, it loses its tax deductibility. With an offset account, this problem doesn't actually exist. And that's because that money, it never actually went into the loan in the first place. And these specifics are absolutely a conversation you should have with your accountant. And if you're an investor using a redraw facility, please don't skip that conversation. Your bank is unlikely to bring any of this up. And that's because a redraw kind of works more in their favor. It's money that belongs to them. So before anything else today, make sure that you check whether what you are using is a redraw facility or an actual offset account. The next mistake is about a comparison that nobody ever does. And look, it can get a little bit mathy, but let me try and break it down simply for you. On that savings account, let's say you're getting a 5% interest return. And that's a pretty solid return. On the surface level, it looks fine, right? But the interest you earn on your money in your savings account, it does actually add towards your taxable income. So depending on what tax bracket you're in, the money of that return you're actually keeping could be notably lower than what you're actually thinking that headline rate is. And your accountant can give you the exact number for this situation. But what I can tell you is this: every dollar that you have sitting in your offset account is saving you interest on the full rate that your loan is on. And that savings, it isn't taxable income. It's just interest that you're no longer being charged in your loan repayments. If you are on principal and interest repayments, your repayment size stays the same. This is something that trips a lot of people up. Even though you've got money sitting in your offset account, it's not going to make your repayment smaller. However, the interest portion is going to be a lot lower, and that means that the principal section is going to be bigger. And that's the part that actually brings your loan balance down. For a lot of people, when you actually run that comparison, the offset account does tend to win by a margin that genuinely surprises them. If you haven't done that calculation, it's worth doing. Let's talk about some real numbers now and the 3 paths that your money can take. In our ebook, we ran a comparison. The scenario on a $700,000 loan at a 6.5% interest rate refinanced down to a 5.75% interest rate. The interest saving over the next 3 years came to around about $15,700. Now that's what we call the loyalty tax that people hand to their bank because they're just going to sit there and do nothing while they might be sitting on an interest rate that's higher than what they could be on elsewhere. But here's what our ebook didn't actually go into. Because when people refinance and they see that, hey, we're saving an extra $300 on every monthly repayment, that money can really quickly disappear into coffees, eating out more, petrol. It just vanishes like that, right? We've all been there. And I've done it myself, trust me. And 3 years later, you've got nothing to show for those savings. Path A, you don't refinance. You stay on that higher interest rate, and 3 years later, you've handed that $15,700 right into your bank's pocket. Now, that's the loyalty tax. Now, path B is you do refinance, and you're making or getting that $300 savings on every monthly repayment because it's cheaper by $300. However, you don't really keep track of that money, and it just disappears. So 3 years later, you've saved $15,700 from going into the bank's pocket, but you don't really have much to show for it because it's disappeared. Path C is where you refinance and you get that better interest rate, lower monthly repayments, and the difference or that $300 savings that you're making, every single month you put that into your offset account and that quietly just builds up over time. What this results in is you've saved yourself $15,700 from landing in your bank's pocket, but you've now also got about $11,000 sitting in your offset account. And over the course of those 3 years, every dollar sitting in your offset account is reducing your loan balance every day, minimizing the amount of interest you're paying over the life of your loan. With Path C, you're still living the same lifestyle you were on, but now you're putting that $300 every month to work in your offset account. It's reducing the loan balance for when the bank does their interest calculation every day. So it means you're paying less interest over the life of the loan. This is the best thing about the offset account. You changed nothing about your lifestyle and your offset account did the work here. And that's what this account actually is. I like to think of it as a bit of a compounding interest shield that you're protecting yourself with. Here's the part that most people don't connect with their offset account. As that offset account balance grows, your effective loan position shrinks day by day, which means your equity position is quietly getting stronger without making a single extra repayment. This equity position matters more than it sounds. We're going to come back to that in our next videos. Next video, we're going to be talking about loan structure because there's more than just rates and offset accounts. They're only two pieces of the puzzle. The way your loan is actually set up, principal and interest only, the loan term that you're on, fixed versus variable rate, all of it affects how efficiently your money is working. And getting that wrong can cost you more than a bad rate ever could. We'll see you in the next video.